All right, please confirm you can hear me clearly.
Good evening,
Very
sir.
loud. Sir. Good evening.
Sorry
evening,
for
sir.
this space. I thought it was PM class. I was going to PM class. Sorry, please. All right, once again, good evening. Our class tonight, we are looking at bond valuation. We shall be discussing valuation of bonds. What is this topic all about? It's about how to determine the price, the appropriate price to pay.
Hello, sir.
Yes.
Hello, sir. Yes. Is that all that there is to it, to the theory of capital structure, sir?
Okay, can you mute?
Okay, sir.
That issue has been settled. Why? Because it was meant to explain those theories so as to assist your cost of capital computation. The theory is about the impact of change in capital structure on the cost of capital and on corporate value. Deliberately, we have used one question to explain this because you are still going to have that topic extended under cost of capital computation. That theory will be extended in the course of doing your cost of capital computation. That is why once we explain the theory, we look for a question that can explain the impact of capital structure on the cost of capital and on corporate value. Is that clear, sir? So it wasn't an error. You know it's an SFM we are doing. The knowledge you have gotten from capital structure now will be extended in your cost of capital calculation. And if you look at the period you spent on cost of capital computation, a lot of hours or many hours are allotted to that cost of capital. That is the reason, sir. I hope it's clear.
It is, sir. Thank you, sir.
In some cases, I will just not do it again. I'll just allow, in some situations, I will not even bother teaching it. Because I know that that same knowledge will be repeated in your cost of capital computation. All right, let's move to bond valuation. All right, like I was trying to explain. Bond valuation. What is the whole objective of bond valuation? Is to provide the knowledge required to determine the price at which you can buy or sell a bond. Bond valuation. I said the objective of this topic is to provide the skills and knowledge required to be able to determine the price of a bond, the price at which you can buy bond or you can sell your bond. Why are we interested in knowing the price? Why should we be interested in knowing the appropriate price of a bond? This is because it provides you with the knowledge of the returns you are going to get on your bond. If you don't know the appropriate price, then the seller can take advantage. Just as we try to know the price, we carry out valuation to be able to know the price of a stock at the stock market. Share price is not static. That instrument is tradable. The price is subject to fluctuation. The investors in shares must be able to determine the appropriate price for the shares. Same applies to bonds. Investors in bonds should know the appropriate price to pay when buying bonds, or the appropriate price to sell if you are to sell your bond. I will explain this. What is bond really? Assuming you are asked, what is bond? A bond, a debt instrument that authorizes the issuer to repay the amount borrowed plus the interest elements to the lenders or the investor. I will take that again. A bond, a debt instrument that requires the issuer of the bond to repay the lender the amount borrowed plus the interest elements over agreed specified period of time. A bond is a legal instrument that establishes a contract between the borrower and the lender. Legal instruments that establishes a relationship between the borrower and the lender. This instrument authorizes the borrower to repay the amount borrowed plus the interest element to the lender. From this definition, There are two parties to bond. If you look at the explanation we have given, there are two parties to bond. We have the issuer of the bond. The issuer is the borrower. We have the investors. The investors are the lenders. Let us illustrate this briefly. Let us try to illustrate this. Assuming Dangote is planning to borrow money. Dangote as a company is planning to borrow money. Dangote can approach the bond markets. Dangote can approach the bond markets for the purpose of issuing bonds. Dangote will issue the bond to the general public. Any individual can decide to invest in Dangote bond. Any individual can decide to invest in Dangote bond. If you invest in Dangote bond, then you become an investor. You are providing money for Dangote. Dangote is borrowing money from you. In this Dangote company is the borrower. The investors are the lender. This instrument establishes a relationship between Dangote, the borrower, and the investors, the lender. The instrument authorizes Dangote to repay the amount borrowed plus the interest elements to the investors, that is the lender, over agreed specified period. That is bond. If you look at it from the perspective of the borrower, perspective of the borrower, a bond is a liability. The interest payable on the bond is an asset. Sorry, it's an expense. That's again. We said the perspective of the borrower is a liability. The interest payable is an expense. And the perspective of the lender, bond, investment assets. The interest receivable on the bond is an income. Please get that clear. If you are asked to explain bond, you are going to ask the owner, should I explain from the perspective of the borrower, or should I explain from the perspective of the lender? All right. The key characteristic of bond. What are the essential features of bond? Oh, the audio is breaking. Please, can you hear me now?
Yes, sir.
Okay, sir. It's okay now.
It's better, right?
Yes, sir.
Please, if the audio is breaking, let me know. At times, it might be from me. At times, it might be from the particular student. So please notify me on time. Gabriel, can you hear me now?
Yes, sir. I can hear you, sir.
Okay. Now we're looking at characteristic of bond, or you can call it terms associated with bond. One of these is the face value. The face value of the bond is the amount written on the face of a bond. The face value is the amount written on the face of the bond. Please note, the face value be 100 naira or 1,000 naira. Please note, the face value can be 100 or 1,000 naira. Also note, the face value is also known as the nominal value. The face value is also known as the nominal value of the bond. This nominal value can be 100 naira or 1,000 naira. Also note this, if the examiner is silent about the face value, where the question is silent about the face value, you can assume either 100 naira or 1,000 naira. Please, 1 minute. Let's go on with the class. Number 2, the coupon rate. The coupon rate is the annual interest rate that is stated on the face of bond. The annual interest rate stated on the face of a bond. This coupon rate could be fixed 5% annually, 10% annually. The coupon rate may be fixed, or coupon rate may be floating rate. When we say floating rate, the interest rate will fluctuate every year. The interest rate fluctuates with fluctuation in market interest rates. That means year in, year out, this interest rate will be changing depending on the market interest rate. The market interest is by the central bank. The monetary policy. Let me take that again. The market interest rate is determined by the central bank monetary policy situation. Also, you can have zero coupon bond, a zero rate coupon bond. You can go to your study path, look at the outline or the table of contents. I don't know that page on my head. Now, zero coupon bonds. Interest is not payable on this bond. Zero coupon bonds that do not pay any interest. These are bonds that do not pay any interest during their entire life. These bonds are issued at a discount to the face value. This bond will be issued at a discount, but we mature at the face value. This bond will be issued at a discount, but we mature at the face value. Just 1 minute. Let's go on with the class. This bond will mature at their face value. The return on such bond is called capital appreciation or capital gain. The return on such bond is the difference between the face value and the issue price. The return on such bond is the difference between the face value at maturity and the issue price of the bond. Next, we have premium bond. When you say a bond is premium, a premium bond, a bond with market value greater than its face value. A premium bond is a bond with a market value greater than its face value. Remember, the face value is 100 naira. If the market value is greater than 100 naira, then that bond is called premium bond. Next, we have discount bond. Next, we have discount bond. A bond with market value less than its face value. A bond with market value less than its face value. This is called premium bond. Where the market value of the bond is less than 100 naira, then we are going to call it a premium bond. Sorry, we are going to
So
call
discount.
it discount bond. Thank you. Then we have par bond. What is par bond? A par bond, a bond with market value equal to the face value, where the market price of the bond is 100 naira. The market price of the bond is 100 naira. Then that bond will be called par bond. Any question, please?
Hello, sir.
Yeah.
The zero coupon bond and
Yeah.
the one with the discount bond, I don't really
Yeah.
get the difference clearly.
All right, discount bond. Let's say discount bond. When we say discount bond, a bond where the market value of the bond is lower than the face value of the bond. For example, if the market price is 95 naira, you know that the face value is 100 naira. That one is constant. Face value could be 100 naira or 1,000. If the market price is now 95 naira, 95 naira is less than 100 naira face value. That will be called discount bond. That one is clear out. Zero coupon bond. A bond that does not pay any interest. No interest is paid on the bond. Zero rate coupon. That means if you invest in that bond, year one, they will not pay you any interest. Year two, they will not pay you any interest. Year three, no interest is paid to the investor until the maturity. No interest will be paid. We now said this bond will be issued at a discount. The bond, zero coupon bond, is issued at a discount. That means the issue price is less than 100 naira. It may be issued at 60 naira. That means if you are going to buy it, you are going to pay 60 naira to buy one bond. The bond is issued at a discount, 60 naira. But at maturity, the bond will mature at the face value. The face value is 100 naira. At maturity, this bond will mature at 100 naira. What does that mean? At maturity, the borrower will pay you 100 naira. What you buy for 60 naira, the borrower will now repay you 100 naira. That means your profit on the bond is difference between 100 naira face value and issue price 60 naira. Your profit is now 40 naira per bond. But this bond will not pay you interest annually. Is that clear now?
Sir,
Yes, sir.
okay, sir, please, what you are saying in essence is, you buy at discount and it's redeemed at par.
That's what we are saying. You buy at a discount.
Yes.
Issued at a discount.
Yes.
Redeemed at face value.
At face value. Okay, thank you.
All right, let's proceed. You can meet. Please excuse my standing. At times I get tired sitting. Valuation of bonds. How do we value bonds? Please note, the method of valuing bonds will depend on the type of bonds you are required to value. I will take that again. The method of valuing a bond will depend on the type of bond you are required to value. Basically, we have three types of bonds. Basically, we have three types of bonds. One is redeemable bonds. The first bonds. What is redeemable bonds? Redeemable bonds, a bond with a specific maturity date. Redeemable bond is a bond with a specific repayment date. There is a particular date this bond will be redeemed or repaid. It could be 5 years, 10 years, 3 years. Examiner will give the date of redemption. Now, how can we value redeemable bonds? Valuation of redeemable bonds. A redeemable bond, or let's say price of a redeemable bond. The price of a redeemable bond is calculated as the present value of the cash flows, the expected cash flows from the redeemable bond. I will take that again. The price per redeemable bond is calculated the present value of the cash flows, expected cash flows from the redeemable bond. What are these cash flows? What are these cash flows? Annual bond interest from year 1 to maturity. Annual coupon interest from year 1 to maturity. So you are going to calculate the interest. Interest in year 1, interest in year 2, interest in year 3, up to the maturity date. Next, redemption value of the bond at maturity. Number 2, cash flow. The redemption value of the bond at maturity. Please note, a bond at a premium or at a discount or at par value. Please note, a bond may be redeemed at a premium or at a discount or at par value. When you get your cash, you are going to discount these cash flows to their present value. When you get your cash flows, you are going to discount these cash flows to their present value. Your discounting rate is the bond yield. The discounting rate to use is the bond yield. The yield. We are coming to that later. How to determine the yield. We have explained the equation of redeemable bond. Next, valuation of irredeemable bond and irredeemable bond. What is irredeemable bond? A bond, a debt instrument without a specific repayment date. A debt instrument without a specific repayment date. That is an irredeemable bond. A bond without a specific repayment date. This bond will not be redeemed. There is no maturity period. What it means is that the principal amount will not be repaid. The borrower will continue to pay the interest forever. Inasmuch as the company is in business, the borrower continues to pay the interest from year one to perpetuity. Now, how can we value an irredeemable bond? A bond without a specific maturity date. Please note, the price of an irredeemable bond, the price of an irredeemable bond is calculated as the present value of the interest cash flow to perpetuity. The present value of the interest cash flow to perpetuity. That is, you are going to calculate the annual interest, then divide it by the bond yield. You are going to calculate annual interest, then divide the annual interest by the bond yield. That is the present value of the cash flow, the interest cash flow to perpetuity. We have explained redeemable bond. We have explained an irredeemable bond. Our next explanation, convertible bond. Valuation of convertible bond. Valuation of convertible bond. First, what is convertible bond? These are debt instruments that can be converted to equity shares. Debt instruments that give the option of conversion to equity shares to the debt holder. It's an option to convert to equity, not an obligation. Convertible bond, debt instruments that gives the debt holders the rights but not the obligation to convert the debt to a specified amount of equity shares, a specified quantity of equity shares within a specified period. This implies that convertible bond contain elements of debt and equity. Convertible bond contains elements of debt and equity option. I will explain this. How can we determine the price or the value of a convertible bond? Let's go on with the class. There are two methods of calculating value of convertible bonds. There are two methods of calculating of a convertible bond. Number one method, you can use valuation as a straight debt. Straight debt. This method assumes that the convertible bond will not be converted to equity shares. This method assumes that your convertible bond will not be converted to equity shares. In this case, all right, Charity, let me hear you out.
Good evening, sir.
Please hold on.
Can you hear me, sir?
Okay, go ahead now.
Okay, you said there are two methods of calculating valuation of convertible bond. But when
Yes,
you were
ma'am.
calling out the method, I could not hear you. The sound was breaking, so I didn't hear any of it.
Okay, that's fine. But can you hear me now?
Yes, I can.
Because I can hear you. All right, let's go to it. There are two methods of calculating value of convertible bonds. Method number one, valuation as a straight debt. Look at it here. Debt. This method please hold on. Convertible bond will not be converted. The bond will remain as debt. That convertible bond will not be converted to equity shares. In this case, the price stated as present value of the expected cash flows from the convertible bond. In this case, the price of the convertible bond will be calculated as the present value of the cash flows, expected cash flows from the convertible bond. What are these cash flows? Annual interest from year one to maturity. That debt will not be converted to equity. So you are going to calculate annual interest in year one, year two, year three, up to the then the redemption value of the bond at maturity. Redemption value of the bond at maturity. When you get the cash flows, you now discount to their present value. This will be discounted at the required, look at the screen, please. Required return on ordinary debt. Ordinary debt of the same risk class. Required return on ordinary debt risk class. That is method 1. Let's go on with the class. Please confirm you can hear me.
I can hear you, sir.
All right, Mustafa. Method number 2. Conversion value. Method 2, conversion value. This method assumes that the convertible bond will be converted to equity shares. This method assumes that the convertible bond will be converted to equity shares. And the value of the equity shares can be calculated with the formula below. Please look at below. I'm trying to expand this. So you are going to calculate the value of the equity shares. Look at the formula. Conversion value in year N is equal to PO bracket 1 plus G raised to power N multiplied by R. Your PO is the current share price. Your G, annual growth rate in share price. Your L, number of years the bondholder can exercise his rights, the right of conversion. Your capital letter R, conversion ratio, that is number of equity shares a bond can be converted. These are the 3 you may be required to value. We have explained how to value bond. But to value bond, you require yield. That means you must understand how to calculate yield. Next discussion. Yield measure. Yield measure. The yield is the return on bond investments. Bond yield is a measure of return on bond investments. It shows the potential returns investor will get if you invest in bond. We now have different types of yield. We have the nominal yield. Your nominal yield is the coupon rate of the bond. The coupon rate of the bond is the nominal yield. That is the interest rate. Yes, please. The interest rate on the, yes, Charity.
Sorry, sir, that I'm drawing you back. But you said yield is what?
Yield is return on bond.
Okay, sir. Thank you so much.
All right, you're welcome. That is the return, your potential return. Look at it. Potential or expected return. That is the yield. We now said we have three types of yield. We have the nominal yield. Our nominal yield is the annual coupon rate of interest. That is your nominal yield. Number two, you have the current yield. The current yield or the current yield, this relates annual coupon interest to the market price of the bond. The current yield relates annual coupon interest to the current market price of a bond. Our current yield is calculated as annual coupon interest divided by the market price of the bond. Our current yield is the annual coupon interest divided by the market price of the bond. The current yield represents the current income on the bond. The current income from the bond investment. This current income or current yield or current return is the return you are going to get if you are taking your return annually. If you are interested in getting your return annually every year, then the current yield. This yield is only important to income-oriented investors. This yield is only important to income-oriented investors. Investors that are interested in annual return. Then number three, the yield to maturity, ICAN. The yield to maturity of a bond. What is the yield to maturity? First, yield to maturity is the most widely used bond yield measure. Is the most widely used bond yield measure. The yield to maturity considers the interest income, capital gain or loss, and it also considers the time value of money. It considers the timing of the cash flow received over the life of a bond. Please note the yield to maturity of a bond is the internal rate of return of the cash flows associated with that bond. Please, ladies and gentlemen, please note this word. The yield to maturity of a bond is the internal rate of return of the cash flows associated with that bond. Please, what is internal rate of return? Our internal return is the minimum return a project must generate if that project is to break even. Please, just 1 minute. Ah. Please, just 1 minute. Let's continue with the class. Sorry, I just have to take water. Let's go ahead with the class. We said the internal rate of return is the minimum rate a project should generate. The minimum rate of return a project should generate or earn if that project is to achieve breakeven. Recall how to calculate internal rate of return. You are going to assume two discount rates. One that will give you positive NPV and one that will give you negative NPV. Then you now use this information. The two discount rates, positive and negative NPV. We now use interpolation approach to determine the internal rate of return of the cash flow. That will represent your yield to maturity. Also note, your yield to maturity is also called gross redemption yield. Gross redemption yield. So in example, examiner can ask you, calculate the gross redemption yield. All right. Next, assumption of YTN. There are three. When you put the YTN, this calculation is on three assumptions. One is, it is assumed that all coupon can be reinvested at the rate of the YTN. All the coupon on the, when we say coupon, coupon means interest. All the interest can be reinvested at the rate of the YTM. Please, can you please, can you confirm you can hear me now?
Yes, it's better now.
All right, let me take that assumption again. We said number one assumption. All funds can be reinvested at the rate of the YTM. The reinvestment assumption implies a flat yield curve. Number two, assume that the bond is hedged to maturity. The bond will be hedged until maturity of the bond. That means is that investor is not expected to sell the bond before maturity. Issuer is expected to sell the bond before maturity. As an investor, I will not sell my bond until maturity. The company also will not call the bond until maturity. The company will not pay ahead, will not repay the loan. And when we say call, the company will not repay the loan until maturity. The bond is expected to be hedged until maturity date. That's why we call it yield to maturity. Return I will get on my bond if I maintain this investment until maturity. That is the literal meaning. The return I'm going to get on my bond if I maintain this investment until maturity. Number three, all coupons are received in prompt and timely fashion. What that means is that if the interest is paid every 31st of December, the company must pay you every 31st. 31st December, you must receive your coupon rate. On that same day, you are going to invest it. Coupons are received promptly in timely fashion. There must be specific dates. Like if you look at companies, some companies, they have a specific date they will pay salary. Some will say every 24th of the month. That means the company must pay us or must pay its staff every 24th. That payment must be received promptly and in timely fashion. All right. Please note the assumption. Next discussion. Bond duration. Bond duration. Duration is the measurement of the average life of a bond. Duration is the measure of the average life of a bond. It measures the sensitivity of a bond price. The sensitivity, it measures the sensitivity of a bond price to a change in interest rates. Duration measures sensitivity of a bond price to a change or to changes in market interest rates. The higher the sensitivity, the higher the duration, the higher the risk. The higher the sensitivity, the higher the duration, the higher the risk. Duration is extremely important when it comes to bond valuation. It measures how long duration measures how long it will take a bond investor to recover or recoup the amount invested in bonds. Duration explains or tells us how long it will take a bond investor to recoup the amount invested in bonds. If you look at it, duration is my payback period. If I invest 10 million in this bond, how long will it take me to recover the amount I've invested? That is what duration is trying to calculate. Steps involved if you have to calculate duration. What are the steps involved if you have to calculate duration? One, you are going to calculate the YTM of the bond. If you are not given, you are going to calculate the bond YTM. That is step number one. Step two, use the calculated YTM to discount the cash flows from the bond. You are going to use the calculated YTM as the discount rates for the cash flow of that bond. Then step number three, you are going to calculate duration as summation of present value multiplied by n divided by summation of the present value. You are going to calculate duration as summation of present value multiplied by n. Divided by the summation of the present value. All right. The significance of bond duration. What is the
There is
relevancy or what are the significance of bond duration? First, duration is an indication of the price sensitivity of a bond to a change in market interest rates. Duration is an indication. Yes, please.
Okay.
Mustafa.
Okay, sir. I'm sorry to bring you back a bit, sir. I'm looking at the this duration formula, summation of present value multiplied by n divided by summation of present value. I think that brings me back to n.
When we get to competition, that's
Okay.
clear, Mustafa.
Yes, sir.
That it will change. Let's get to competition. All right. We are trying to explain the significance of bond duration. One is, or the first point to note is, duration is an indication of the price sensitivity of a bond to a change in market yield or market interest rates. Duration is used to monitor the risk involved in bond portfolio. You can use your duration to monitor the risk profile of bond portfolio. Duration allows bonds with different coupon rates and maturity period to be compared directly. This enables investors to manage the risk involved in the bond portfolio. We said duration. It allows bonds with different coupon rates and different maturity period to be compared. Thereby allowing the investors to manage the risk in their bond portfolio by selecting an appropriate bond for investment. That's enough. It's enough for that purpose. Modified duration. Modified duration is closely related to duration. The concept of modified duration is closely related to duration and is calculated as duration divided by 1 plus 5 years. If you have to calculate modified duration, you are going to pick your duration, divide it by 1 plus the white year. Modified duration is used to estimate approximate change in the value of a bond or the price of a bond, where there is a small change in interest rates. Your interest rate is your yield. Modified duration is used to estimate approximate change in the value of a bond where there is a small change in the interest rates, in the interest. Credit risk, credit spread. Let's explain this together. What is credit risk? The risk that the bond issue a credit risk is the risk that I'm trying to wait. Network is fluctuating. Let's go on. Credit risk is the risk that the bond issuer may fail to honor the interest payments or the principal repayment as at when due. Credit risk, a risk that when a company issue bond, that company may fail to honor the terms of the bond contracts. The company may fail to pay the interest or the principal repayment as agreed. This risk is peculiar to corporate bond. This is peculiar to companies bond. Government bond is risk-free. So please remember, if you are dealing with companies bond, corporate bond, bear in mind that there is element of risk involved. But if you are dealing with government bond, government bond are assumed to be risk-free. Now, credit spread. Credit spread is the premium payable to investors. Investors in corporate bond. Credit spread is the premium or additional return payable to investors in corporate bond to compensate for the credit risk of the corporate bond. If you are trying to invest your money in corporate bond, the company will pay you additional return, which is higher than the risk-free rate. If you invest in government bonds, government will pay you a risk-free rate of return. This risk-free rate is usually very low, maybe 2% or 3%. But if you invest your money in corporate bonds, because there is risk involved in corporate bonds, that corporate company will pay you return higher than return payable on government bonds. That extra return payable to investor in corporate bonds to compensate for the credit risk is what we call credit spread. We now have what we call government sportive call. No, I'll move out of here. I have to explain that. Yeah, this is it. The youth call. Your youth call should between annual interest rates and the maturity period. The youth curve shows relationship between the annual interest rates and the maturity period. Usually, the longer the maturity, the higher the interest is. Usually, the higher the interest is. Shows relationship between annual interest rate payments and the maturity period. You have you cost, and you can have yield cost. You can have government yield curve. Now we have explained yield curve. The yield curve, a curve that shows relationship between annual interest rates and the maturity period. Usually, the longer the maturity, the higher the interest rate paid. We now state there are two types of yield curve. You can have government sports yield curve. You can have government sports yield curve. This curve shows relationship between interest rates payable on government bonds and the maturity periods. Government sports yield curve show relationship between the annual interest rates payable on government bonds and the maturity period of the government bonds. Please note this point. Government sports yield curve can only be used government bond. You can write this point down. Government sports yield curve can only be used to calculate the price of a government bond. That is one. Number two, corporate yield curve. Corporate yield curve shows relationship between annual interest rates payable on corporate bonds and the maturity corporate bonds. Corporate yield curve. A curve that shows relationship interest rates and the maturity dates of the corporate bonds. Notes. Please note, you can get your corporate bonds, your corporate yield rate. Look at it. The yield, please look at this. Corporate yield curve is equal to government yield curve plus credit spread. The yield on corporate bonds is calculated as the yield on equivalent government bond of a corporate company. Please note this down. Corporate yield curve can only be used to value corporate bonds. The corporate yield curve will be used for the valuation of corporate bonds. Any question? Wow. Any question? We need to put question to what we have explained. Okay. This topic is wide. Can we accommodate one question tonight? Let's try. I'm actually tired.
Sorry, sir. Well done.
Let's try. Let's go to page what now? Look at question one. Does anybody open that page?
What page, sir?
If you not even know the page, I have to go to that your material now.
Oh, okay.
That's
Hold
the
on,
plan.
sir.
I have to go to the
Okay,
material.
page 100.
Go and look at question one. Kazare Limited.
It's page 100.
Oh, page 100.
Yes.
Okay, please, let's refer to page 100. Thank you, Ibrahim. Let's refer to page 100, question number one. Kazare Limited. Let us see if you can spend like 40 minutes. Are we there, please? Are we
Yes.
there, please? Right. Let's go to the question. Kazare Limited. Kazare Limited has a cash surplus of 20 million naira, which the finance manager is free to invest in corporate bond. Look at it. The finance manager is keen to invest 20 million in corporate bonds. He has identified two potential investment opportunities in two different companies, which are both rated A by the major credit rating agencies. Bond A, the issuer plans to raise 50 million naira, 2-year bond with a coupon rate of 10%. The bond is redeemable at a premium of 8% to nominal value. Bond B, the issuer plans to raise the 3-year bond with a coupon rate of 12%, redeemable as per the annual sports yield curve for government bond is giving year 1 9.5%, year 2 10.4%, year 3 10.5%. Next, extracts from a major credit rating agency website. Table of spread in basis points is given below. We have triple A's. If the company is rated triple A's, you have the credit spread. Double A's, single A, you have the credit spread. Requirement A. For a nominal value of 1,000, can you see it? Examiner says the nominal value, that is the face value, for a face value of 1,000, calculate the theoretical issue prices of the two bonds and indicate how many of each of these bonds Casaure Limited can buy, assuming it is one.
We can't hear you, sir.
Can you confirm you can hear me?
Okay, now we can, sir.
Okay, you can hear me, fine. Let's go ahead. Now I'm trying to explain. If you are asked to calculate theoretical price, theoretical issue price, or the issue price, what the examiner is asking you is the market price of the bond. Examiner can use issue price, theoretical issue price, market price, or market value. Any of these can be used interchangeably. Now, we need to calculate the price of this bond. What type of bond is this? If you look at bond 1, bond A, this bond will mature in 2 years. If you look at bond B will mature in 3 years. That means you are dealing with redeemable bond. A bond with a specific maturity date. That means you are dealing with what? Both bond A and bond B are redeemable bonds. I will settle this. You now ask yourself, how can I calculate the price of a redeemable bond? How can I determine the value of a redeemable bond? Remember, we explained this. The price of a redeemable bond is calculated as the internal rate of return. Sorry, is calculated as the present value of the cash flows, expected cash flows from the redeemable bond, present value of the expected cash flows from the redeemable bond. These cash flows will be discounted by the bond yield. That means we need to calculate the bond yield. This bond is a corporate bond, company's bond. Casaure is planning to invest money in two companies' bonds. That means I require a corporate yield rate. I will not come in. My first working one. Calculation of corporate yield cost, or you can call it rates. You have your year one, year two, year three. Now, examiner gave us government force yield. The examiner gave us government force yield. Year one, year two, year three. Refer to the question. Look at it. The annual force yield curve for government bonds. Look at the rates. Pick it. Please get your calculator near you, please. 9.5%, 10.4%, 10.5%. Now go and pick the credit spread. This, look at it. Companies so pick the credit at 50 basis points.
Sir.
Let's go on
Can you?
with class.
Okay.
It was a temporary, but I must thank God today at least it wasn't that bad. So we come here. Now this is points. This credit point is given in basis points. You have to convert the basis points to percentage. To convert to percentage, you are going to do like this. You are going to divide the basis points by 100. 20 divided by 100 is 0.2%. 30 divided by 100 is 0.3%. 50 divided by 100, that is 0.5%. You can now sum up. (9.7%), 10.7%, 11%. You have gotten the corporate rates. This is the rate appropriate for formation of corporate bond. We pick the government spot yield curve, and this was adjusted by the credit spread of rated companies. That's your working one. You now pick bond B, bond A. Bond A. What are the features of bond A? What is the maturity? Maturity is 2 years. What is the face value? The face value is the nominal value, 10,000. What is the coupon rate of bond A? The coupon rate is the interest rate, 10%. What is the redemption value of bond A?
1,000.
The redemption value
1,000.
at 8% premium.
Okay. 4.2.
That means you are going to calculate 8% of the nominal value, premium added. These are the features of bond A. Now get your cash flow out. Expected cash flows. Annual interest. 10% of the face value. Please note, interest is calculated on the face value or the nominal value. 100. Year 1. Annual interest again. 10% of 1,000. That is 100. Year 2. This bond is for 2 years. Then redemption value. redemption value at maturity. At maturity. Examiner says 8% premium. So the nominal value, look at it. Look at it, the premium, look at it. Premium 8% of 1,000. That will give us 80. Then nominal value. Nominal value 1,000. Total amount 80 plus 1,000. You are going to have 1,080. That is the redemption value at maturity, year 2. If you look at it, in year 2, you have annual interest, you also have redemption value. You can plus these two together. Year 2, year 2. We can now calculate the price. Price of bond A, that is the present value. Price of bond A is equal to cash flow in year 1 divided by 1 plus ROE in year 1 raised to power 1 plus cash flow in year 2 divided by 1 plus R in year raised to power 2. Your R is the corporate rate. What is cash flow in year 1? 100 naira. What is rate in year 1? 9.7%. That is present value you are doing. Price is equal to 100 in year 1, 1 plus 9%, 9.7%, 0.097 into bracket raised to power 1 plus cash flow in year 2, annual interest, 100 naira plus 1,080. That will give me 1,180. 1,180. Divided by 1 plus ROE year 2, 10.7. 10.7%. Please work this out. What is the price of bond A? Please apply your calculator and give me final answer. You are going to get 1,054. Please apply your calculator and give me the final answer, or give us the final answer. Anybody done?
1054, sir. So that's 91.15 plus 962.9. Is correct, sir. We can't hear you, sir.
Can you hear me now?
Yes, you can.
I
The
said,
answer 1054.
Galaxy, please stop. Don't touch my screen. You are making a mark on my screen. That is the issue price of bond A. That is how to calculate price of a bond. You go to bond B. Bond B. Maturity is 3 years. Face value is 1,000. Coupon. Coupon rates 10%. Examiner says this bond will be redeemed at par. Redemption value at par.
Sorry, the coupon rate is 12%.
Oh, okay. Sorry. Thank you. Thank you. 12%. Now calculate, get the expected cash. Expected cash flows. 1, annual interest. 12% of the face value, 1,000. This equals 120 year 1. Annual interest is 12% of 1,000, 120 years. You are going to calculate until maturity. 12% of 1,000, 120 year 3. Then redemption value at maturity. Redemption value at maturity. Examiner say at par. The par value is 1,000. That will be in year 3. At the year of maturity, you must have 2 cash flows. The annual interest and the redemption value. You can add these 2 together. You now get the price. Price of bond B is equal to cash flow in year 1, 1 plus R in year 1, raised to power 1, plus cash flow in year 2, 1 plus R in year 2, raised to 2, plus cash flow in year 3, 1 plus R in year 3. Price is equal to cash flow in year 1, 120 naira. 1 plus R in year 1, 0.0797 raised to power 1. Plus cash flow in year 2, 120 over 1 plus. What is R in year 2? 10%. 10.7%. 0.107 raised to power 2. Plus cash flow in year 3, 1,000 plus 120. 1,120 over 1 plus R in year 3, 0.11%. Please work this out. Let's work this out. The price we give you, price of bond B is equal to 1,026 to the nearest. Your R is the corporate rate that we calculated in working one. So you can work this out and confess.
It's correct, sir. 1026.
We are getting the issue price. The issue price for bond A and bond B. That is how to value redeemable bond. The question says, examiner says, calculate the theoretical issue prices of the two bonds and what? Indicate how many of each of the bonds Kasare Limited can buy, assuming it invests in only one of them. So let's calculate that. First, Kasare Limited has 20 million naira. So cash available, 20 million. Now, the price of bond A, 1,054 naira. If you have 20 million naira, and you can buy one bond for 1,054 naira, how many of bond A can you buy? You have 20 million naira cash. Price of bond A is 1,054 naira per bond. How many bonds can you buy?
Divide it.
That means 20 million naira divided by the price per bond. Look at it. Number of bonds Kasare Limited can buy. If bond A, then you can buy 20 million naira divided by 1054. 18,000 what? 18,000
975.
975 bonds. Or if bond B, he has 20 million. He can either buy bond A or bond B. 20 million. Price of bond B, 1026. He can buy how many of bond B? 19,000 what?
493.
493 bonds. You are done with requirement A. You are done with requirement what? We can take requirement B for 5 minutes. The question says, irrespective of your answer in A above, assume bond A is issued at 1,054 and bond B issued at 1,026. Calculate the yield to maturity of each bond. Remember yield to maturity, the internal rate of return of the cash flows from the bond. So, requirement P1, calculation of YTL. YTL of bond A. Without wasting time. You want to calculate internal rate of return. Your year, the cash flow. Okay, let me put items. We have the year, because of space, or let me put it here, the year, items, the items, oh, cash flow, discount factor, present value 1, discount factor 2, present values. We have year 0, year 1, year 2. Year issue price. Examiner says the price should be 1054. This will be in brackets. This is the price at which you can buy one bond. Then interest in year 1, 1,000, 100. Interest in year 2 plus redemption. Plus the redemption, 1,018. We now need to get internal rate of return of this cash. You are going to assume 2 discount rates. You are free to assume anything, any rate. You can start with 10%. 10% assumption. Find the discount factor at 10%. Year 0 is 1. Year 1, 0.909. This is 1. Year 2, 0.826. Now get your present value. 1 multiplied by the cash flow. 10540. This will give me 90.9. Now please multiply 1,000 and 1,180.
Nine 97468.
What do you have?
974
4.7.
74.68. Yes.
You see? Now get the net present value. Positive or negative? 974.7 plus 90.9 minus. This is positive 11.6. At 10%, the NPV is positive. If I want to achieve negative, what will I do to the rates? Hello.
Less percentage.
We'll reduce it.
I didn't get that. Are we going to reduce?
Lower percentage, like 5%.
That is wrong. If at 10% you got positive NPV, for you to get negative, you must increase your rates. You must increase your cost of capital. You can take this to 15%. If you reduce your rate, you are going to get positive again. At 15%, this is 0.870. Then you have 0.756. Get your present value. Discount factor multiplied by 0.6, 87.0, 1180 multiplied by 0.756.
That's 892.892.
892.1 plus this minus negative 74.9. Now get your white
75.
here. No problem. Your white here. That is internal rate of return. You start with the lower rates. 10 plus positive NPV, 11.6 divided by 11.6 plus 74.9. Put this in brackets. Multiply by higher rates. 15 minus 10. Please, what is the internal rate of return? Finance. $10.67. That is the outcome.
It's correct. 10.67.
If you are to do for bond B, the same thing. Bond B is for 3 years. YTN of bond B. You have your year. You have your item. You have the cash flow. You have the discount factor. You have the present value 1. Discount factor 2. Present value 2. Year 1 to 3. 0, 1, 2, 3. The issue price is in year 0. 1026. That will be in brackets. Interest. Interest. Interest plus redemption. Here you have 120, 120, 1,120. Please, what is the internal rate of return? You are going to assume 2 discount rates. You can pick 10 also, 10%. This is 1, 0.909, 0.86, 0.751. Multiply present value. 120 multiplied by 0.09.
109.
109.1. 0.826 multiplied by
99.
120. 99.1. Next.
841. 841.
Everyone, 841. 841. Any points? No. Get your MP. Is it
23.
negative
Positive.
or no space? Okay, 23. Any points?
23. No.
Points.
Oh, okay.
Okay.
So this is at 10%.
Now at 10%, you have positive MPV. Then increase your rate. You can go to 15%. This is 1, 0.870, 0.756, 0. What is here? 8. I'm not sure. 6 what?
657.
6,
657.
8. Approximately, guys.
Okay.
Now get your present value. You have 1 0
736.
multiplied by 120.8. I have 1.4. Next, 0.756 multiplied by 120. 90.7. Next, 1120 multiplied by 0.656. I have 736.
36. Okay. Let's see.
And this step will approximate or 0.96. Now get your MPV. Please, I just want to round up this part, then we can go
94.9.
94.9. Negative. Your white
Yes.
here. Lower rate 10 plus MPB positive 23. 23 plus 94.9 multiplied by 15 minus 10. Your YTM will give you 10.99%.
Eh? 107.
People are leaving the class. Maybe they are tired. We shall stop here.
Okay.
We have extended by 7 minutes. So we have treated part A. We have treated part B. When we meet next week by God's grace, we shall continue from part B.
Okay.
So if there's no question, I will be checking out. May God give us a better understanding. Good night.
Good night, sir.
Good night, sir.